Well, good morning, everyone. It's February 3rd. It's the first week of February. It's a Monday, and I want to talk about the market the week ahead. There's a lot to talk about. A lot to talk about. First of all, we got manufacturing index report today. That's a big report. Then we have international trade, followed by our popular jobless claims and employment situation. We also have a petroleum report, but I'm not expecting any miracles there. Jobless claims, expect somewhere between 210, 220 claims. Not seeing anything special. The biggest driver this week is going to remain coronavirus. Because it's unforeseeable, there's a certain amount of unforeseeability that comes with these viruses. Now, we've been having some positive news that a cocktail from another part of Asia, that a cocktail of mixing an HIV and a flu virus tends to show promising effects, but it's still too early to tell. If we find out a cure for this, it's going to change everything very, very quickly. But this unforeseeability factor is what's driving it. So far, it's been exposed to 20 countries, 360 people have been killed, and that's the official number. We don't know what the real number is. We'll find out a year from now. And there's approximately 17,000 people infected. And the word on the street, and again, I don't know if any of this is true, but the word on the street is that there's over 100,000 people infected. But again, we won't know anything. Interestingly, the stock market, for the first time, even though we're pricing it, we have all this coronavirus and earnings pricing in, the stock market is opening up higher. I am looking at the 50-day moving average. The big support for me is going to be the 320 level, 320.90 level on the SPY. If we could stay above this level, things will be better, much better, especially with earnings being substantially better than expected, Although the most likely scenario is we're going to continue moving lower and go into the twilight zone. And remember something else. In a bearish cycle, not a bearish market cycle, but a bearish period, the one that lasts 20, 30 days, just a typical healthy sell-off, bearish sell-off, the stock market tends to open higher and sag intraday. In a raging, really strong market, in a very bullish market, markets tend to open, the broad market tends to open slightly lower and head higher as the day continues. But again, this is just a rule of thumb. It's not something that happens 100% of the time. And my point being here, the paramount point here is, don't get so bullish just because the stock market's opening higher. Give it a couple of hours and see if it trades below the 321 level on the SPY, which would be the 3,210 level on the big S&P 500. So that's the SPY. It's not looking bad. It's actually looking better than I expected. And it's not overbought anymore, which is really important. Now, in theory, if we could stay near the 50-day moving average for the next several days, we can consolidate and move higher. But I believe there's more negative news on the table. Earnings are still not done yet. There's a lot of vulnerability. The VIX, as we'll show you, the volatility index is near 20. So we're still in danger zone. And we reached such overbought levels. We've had over 90% or close to 90% of stocks in the S&P 500 trade above the 200-day moving average. Whenever that happens, the market typically declines to the 200-day moving average line to give us a little break. That's why I'm expecting the market to trade below the 50-day moving average. But as you could see here, we're no longer over. Look at these overbought levels. It's insane. So we're not overbought right now. We're kind of actually going towards oversold levels, but the market is gaining neutrality, which means it's pausing, it's resting. Now, let's look at the long bond. The long bond's out, is done, I believe. It's down about a 0.20, almost a full basis point. I think we're going to come down. I believe we're going to come down back to the base, and we're going to trend lower. I believe that this downside, this is the peak. Unless we see something that's not priced into the market right now, I believe the 148, 149, 148.93, 149 level is the peak. And I do believe we're going to be bouncing lower and headed lower just like we did here. I think this is as high as the bond market's going to go. And we are overbought once again. As a matter of fact, we have some negative, we've got some interesting divergence here. Divergence, not divergence, because we're seeing a higher high here. And we're seeing we're actually seeing actually no, it's fairly neutral right here. It's not diverging. It's actually neutral. I thought one was above the other, but when I took a good look, I realized they were almost even with one another. But we are overbought here. We are overbought, and I believe bonds are going to start coming down. Expect us to come down to the 50-day line and probably lower, and for the downtrend to resume again. I don't believe interest rates are going to go lower. And I believe if interest rates don't go lower, that means bonds shouldn't go. Remember, there's an inverse relationship between bonds and interest rates. And I think the Fed has stopped lowering interest rates. All right. So if interest rates are going to go higher, that means bonds are going to go lower. All right. Or at least stay near this congestion range for the next few months. Don't expect too much, but if anything, it's much more likely to expect a break to the downside than a break above the upside, especially in the current economic climate. Now, looking at volatility, this is the VIX index. I'm expecting the VIX index to stay near the 17, 18, 20 level. I'm actually surprised that it's this low. This tells us how bullish the US stock market is. A few years ago, when we had just talk about Brexit, this thing spiked. Let me show you this. Look at these spikes, 30, 29, all the time. And then look in the last several months, almost nothing. So again, the stock market's really bullish. It has a lot to do with the fact that Trump and China are working things out. This is very, very positive for the market. And I believe volatility will come down unless we find out something unknown, that there's something completely unknown about this virus and it's getting worse instead of being managed. All right, now let's talk about earnings. Earnings. So here is the scorecard. Earnings for the fourth quarter. Now, everybody was expecting this was supposed to be the last bad quarter, and we were supposed to start getting a better quarter the first quarter, which this is the fourth quarter, just so you know. The first quarter of the year is actually the fourth earnings quarter. So when I say fourth quarter, I'm talking about earnings, not time of year. I just wanted to clarify that. So overall, 85% of stocks, and let's see here. This is important, so I want you guys to keep in mind. Overall, 85% of stocks in the S&P 500 are beating the earnings per share, and 89 are beating revenues. We've had reports come out for a total of 227 stocks, which is roughly half, and the numbers are better than expected. Again, this wasn't supposed to happen till next quarter, but it's already happening now. And a lot of it has to do with the fact that interest rates are low and jobless claims are near a 60-year low, which means people have jobs, people have money, they have spending power, and that's creating more upside for earnings. Again, these are good numbers, but we're only halfway done. Let's talk about tech. Tech is 67% done. Also, the numbers are better than expected. Both the revenue and the EPS is roughly 4.5%, 5% better than expected. This is good. This is really positive, and it's telling us that techs could sustain more upside. We need to pull back. We're overbought, but they can sustain more upside in the long term. Also, in terms of earnings this week, we've got a full plate. We've got, let's see here. Wow. We got Alphabet. We got Beyond Meat, Boot Barn. We got Chipotle. We got Royal Caribbean. We got Disney. We got Ralph Lauren. You name it, we got it. Even Sirius is reporting this week. So expect volatility. But again, keep attention, keep tight, close attention on this coronavirus. The earnings are really taking a back seat to the coronavirus because there's so much unknown, and it can potentially do so much damage to China and other countries. It's already in 20 countries. It's killed 360 people, and I'm willing to bet that the number is higher. So there's an unforeseeability card here. There's a moving target. This coronavirus is a moving target, and it may impact the stock market based on the news that we're seeing. So I am slightly optimistic. I like the earnings. I like the fact that we've got a good economy. Trump is doing a really good job for the economy. This trade war looks like we're getting toward the beginning of the end. Markets are no longer overbought, as you could see here. Look at this. I mean, we've been overbought since November, probably before then. It's the first time we've had a chance to cool off. The question is, are we going to break lower or are we going to consolidate? Either way, don't expect a bear run here. Just expect some much needed downside. So overall, I'm very happy with what I'm seeing. But again, this coronavirus remains a concern. And as soon as I find out more information on this cocktail, this HIV/AIDS cocktail that's mixed with the flu cocktail that's supposedly doing wonders, I'll keep you guys posted. Now, I've got something big for you. First of all, I want to thank everyone for watching the Smart Money Spikes event. This was a great event. We literally have been getting so much positive feedback. It's ridiculous. You don't want to miss it. If you did miss it, we've got a replay, and it's going down tonight at midnight. And yes, I really mean that. Today's the last day. We've been just hammered with questions. Very positive feedback. Probably, I have to say, this is probably my most popular program, and Josh is part of it. This is something really cool. And Josh is a crazy good trader. He is really accurate. This is going to teach you the secret, the sauce to making regular 400+% return gains on a regular basis. I'm not kidding you. Follow the link below. Watch this replay. Take a lot of notes. There's a lot of information there that's very actionable. Again, Smart Money Spikes. It's going offline at midnight. I want to thank everyone who's been giving us the most amazing feedback and support. But folks, we're still only in the first week of February. The year has just begun. You want to create outsized returns. You want to target outsized gains, 400, 350, 450% gains, quadruple gains, triple digit gains. This is the cleanest, smartest way to do it. Smart Money Spikes is the way to go. Follow the link below. Don't procrastinate. This is your last chance. It's going down at midnight. Talk soon.